Long time no see, brother. Tell me a little bit real quick. Who are you and what do you do and what is your goal?
Well, I am from Boston. I am residing in Arlington, Massachusetts for already 10 years. A father to two daughters and a husband to a beautiful woman that I met 10 years ago. That's also happens to be Ukrainian like I am. And basically, I'm a developer and capital manager in the local market in Boston. And I'm looking to grow the business and scale.
So, what does your current portfolio look like right now?
My current portfolio consists of basically three arms. That is the residential side, the commercial side, and the passive income side.
Where does most of your revenue come from and how can I make money with you?
Most of the revenue comes really from the platforms, the arms of the business, which is the residential, the commercial, and the multifamily side. And the way that I would suggest to make money alongside of me is to really understand what kind of investor you are. Are you a beginner and you want to be in short-term investments, which is 8 to 16 months on average, could be as long as 10 to 20 months on shorter deals and longer deals, but they are just a vehicle to get an ROI. The question after that is, what do you do with capital gains? So we have a vehicle for that. And someone who's a very savvy investor and perhaps very accredited, what I mean by that is at least $1 million or $2 million in net worth and up, could easily skip the short-term deals and go right into QOZ, Qualified Opportunity Zone, which now Trump made it permanent, called 2.0, and that allows you to operate virtually with no capital gains. So in other words, if you have a taxable liability with IRS on one side, you can then, instead of taking the money out and spend it like most probably would that are beginners in the investment or especially real estate market, and they celebrate the win after investing in an asset or a hard asset, I should say, in a year and a half, I suggest that the interest and the principal is rolled into something like a qualified opportunity zone, because you can defer your capital gains 10 years. And on the product that we do ground up. So ground up has massive cost segregation and bonus depreciation. Also has tax abatement, property tax abatement. So virtually, if you add everything together between property tax abatement, that is about 5 to 7 years, plus the deferred depreciation, plus the no capital gains strategy on the exit, you have to be 10 years in it. Basically, virtually, you just wash out all of your income, and you come out with whatever you've earned in short term with me and transfer it to long term. You just deferred all your taxes to the 10-year mark. But by the time you get to the 10-year mark, you're washing it out with what? The cost segregation and bonus depreciation and tax abatement. And essentially what you gained inside for 10 years on your capital that you put in from short terms, and let's say your gain is 2x, 3x, you should be more like 3.5x in 10 years in real estate. At least with me, that's what the projects pencil at. There's no capital gains, because why? You're in a qualified opportunity zone. So if you, as an investor, bring money and invest in a qualified, has to be qualified, not just an opportunity zone, has to be vetted and released by the IRS to say you are from now on permitted as a qualified. That's why it's called qualified. You have to qualify it with IRS. Just because you're in an opportunity zone district doesn't mean you're going to get a tax credit. And that's some hard lessons that some may learn, that they think that they're going to get a tax credit. Come to find out, they didn't invest the money prior to qualifying the property with IRS. It's a really kind of, it becomes common sense in development when you're doing massive projects and already doing it at a scale and your experience. But for those that are starting, it's a common mistake. And most accountants, as we know, and attorneys, honestly, really don't know this stuff. You have to have a specialist that understands how to do these things. And then virtually you scale to a qualified opportunity zone, SEC type C fund, right? So that becomes your capital management company, which was called Bridgewater Capital. Bridgewater is basically a company that consists of an acquisition company and a capital company. So more of a finance company than construction and development. And the other layers are the design build construction company, which is Avatar Construction, and that's focused on commercial and multifamily. And there's another arm, which is the residential side, which is short-term, ground up real estate transactions, and that is called attached builders.
Okay.
So pretty much in a nutshell, any investor that wants to either start, let's say $50,000 to $100,000, or some investor that says, look, don't call me unless you have a $25,000 check request. So we have both vehicles.
Let's talk about real estate in Florida right now. Some people say that real estate in Florida is in a bubble. Some people say it's getting ready to go for another run. Some people say they may get rid of property taxes later next year, that once they vote on that. Are you familiar with that?
Oh yeah, I like the governor of Florida. I think he's doing great for the people. And Trump, I think, is following his. Not to give Trump credit, because I believe I think he's following DeSantis in that specific mindset. And I think I'd like to get deeper into that, because I've been studying this, because it's very close to real estate investments. But I think the fact that finally someone realizes that it's not the affordability of housing we should be worried about, I think that's completely backwards. Let's not worry. You know what I like? My go-to saying is, don't worry about the cost, worry about your income. Because when you increase your income, the cost won't matter. So in order to increase the income of people is what? To provide more affordability in the general affordability of life.
All right. Listen, you got to dumb it down for me. I'm an average Joe. I got $250,000. There's a lot of people, real estate developers I know, that want my money, and it's be like, not that they care, but they will take my money and happily flip it in various different deals, whether it's multifamily, commercial, or residential. If I were to give you my money, what differentiates your firm versus your competitors? What would be a good reason for me to what would be a good reason for me to give you my money versus giving it to other developers I know?
Very, very good question. It's a very common question I get asked, and I'm glad you're asking me that, because that is what I've been perfecting over time, like a recipe. And it's not about going to the right attorney or the right real estate agent or the right SEC fund manager or whatever professionals that are out there. It's really knowing what you need to know and just verifying that with those individuals. But there's not one person that really can tell you how it's done. So I kind of put my own recipe together as an entrepreneur, as a businessman, as a visionary. And I said to myself, if I was an investor, I put you know what they say, put yourself in somebody else's shoes. And I said, what if I was an investor and I put, let's say you are me and me is me. And I said, what would you need to have in order to invest? And would you want to be protected with every layer possible out there or not? In other words, treat others like you would like to be treated, right? So that's what I did. And in the last about 3 years or so, it took a while, I finally arrived at a recipe that's nothing that I think is outside of this earth, but it's layers that allow the investors to not just have protection in the operating agreement of an LLC that owns the property. It's not just collateral, but also what is the protection of the investor when everything goes bust, right? And I think a lot of developers, and I hear these different stories in Miami especially, they get these South American money, Argentina, Brazil. And I've talked to some Brazilian and Argentinian family offices, and they were like, we're scared to invest. I go, why? What did I do? No, not you. We just got screwed here and here. I go, tell me about it. And honestly, I can't believe that developers are doing this to those individuals, but also those investors are, I don't know, coming in very unprotected. So I said to myself, whether I'm dealing with an experienced investor or not, it's just not the right thing to do to not protect the investor.
Okay. This is a two-part question. I want to know examples of how investors have gotten screwed that you've heard in other real estate deals. And then I want to know of ways that an investor can protect themselves from getting screwed.
Excellent. You're basically you're peeling the onion. So here's what I've seen over, last, say, 10 years of getting deeper and deeper into investments and raising money and capital. I think that most developers are greedy and selfish. And that's okay. Let them be that way. They're not going to grow that way because the investor will not return. And it's a loss to the developer. I don't know. Maybe they have an unlimited investor funnel, but I don't. So I cherish every investor that comes in. So what I've seen is, and I'll go a little deeper into content of the real estate and tax depreciation, tax strategies. But for example, a limited partner that we call them LPs come in, and they don't have much protection. Not only that they don't have much protection, the developers don't share cost segregation and bonus depreciation with them. So they get issued these K1s or 1099s as an ordinary income, and they get whacked 40%. I mean, does anybody care about that? I do. For example, in my company, I am implementing other measures of how to save on cost, not to make more money as a company or as a general manager of a capital fund, but to be able to give that savings to the investors. Why? Some say you already give a very generous amount to the investors on their ROI and IRR. And I said, well, if I am very close or the same as others, what's so special about me? Why should they leave others and come to me? So my goal, my recipe, my principles are protect the investor as much as possible, share cost depreciation, cost segregation and bonus depreciation, virtually depreciation, up to 100%. And at the same time, allow investors to not be just more protected, but create such a strategy that if the savings are there on a project overall, openly share that with the investors or almost give it all to them. Why? Well, they're the ones that made the project happen. And they need to come back.
Let's say I come into a deal. Let's say you got a 200 door deal, ground up deal. And there's general partners and limited partners. Me coming in as a limited partner to this deal, what are some things as a limited partner that I should take into account or think of in order to protect myself, knowing that I'm going to not really have any decisions in which direction things goes?
Very good question. So what we do to protect the investors, we put them in the LLC itself. It's very hard to get that from developers because they don't want to share control of any kind in case of default. So for example, let's say, the pie is 100%, right, LLC, and the investor wants to have control in the operating agreement, but they want to be discreet from the public. to, to not see that they have any kind of obligations or whatever. So it's legally allowed to be under 20% stake, or or multiple investors have to be under 20% total. And they don't have to guarantee the loan. They don't have to guarantee the liability. But what they do have is the upside of control in case the general partner, the general manager, the GP stack, does something that becomes a default to the bank, to the first lender, auction, whatever. They can still save themselves. What we also do is create an LLC inside the LLC that puts a second mortgage, essentially a second lien, after the first senior debt. First senior debt would be like, the bank that basically gave us the construction loan and the acquisition money, all that stuff. And that's not really easy to achieve. Why? Typical banks, typical lenders don't want any second mortgages behind them. But we were able to, let's just say, negotiate with a lender those terms. And those are the differences that we offer than others don't. So our protection of investors, I feel like, is more superior to others.
All right, so the bank, let's say it's a $20 million project. Bank's a senior lender. They're lending you $15 million on the deal. You're going to form another LLC. It's going to be the second lender. Tell me what that LLC looks like. Who are the partners on that LLC, and are they actually lending the money, or is this just some paperwork that's created?
They're actually lending the money, yeah. So you have the second layer, basically equity partners, that are just not coming in like LPs, limited partners, because limited partners don't have much protection, really. I mean, they're there, they're protected, but not as much as they would be protected with a lien. Lien is a big deal. You have collateral. LPs don't have collateral.
Okay, so then if we're doing a $20 million deal together, can we raise $15 million from the bank and then have a second LLC bring in the other $5 million behind the bank?
Well, typically it's a split, 70-30, 80-20, or 90-10. So the sponsor, which is the initiator, let's say myself and my company, would be the 10, 20, or 30. We usually prefer 10 because we want our capital to go further and secure other deals for the investors. But if we have a group of equity investors that are like, we want more skin from the partner, well, then that's what's negotiated. That is what it is, which further protects the equity partners.
All right. So there's a lot of doctors and lawyers I know. They're younger. They're in their early 40s. They just started making their first couple million, and they want to diversify their portfolio. And they've been sniffing around investing in multifamily properties, but they don't really understand the industry. So let's hypothetically say you have a 100-door unit ground up going. How would you pitch it to them? Very dumbed down, short and sweet. You're drinking beer. It's not complicated. Tell me what the deal looks like. Just give me a hypothetical example. They know nothing, right? They don't know what don't even bring into the opportunity zone stuff. I just want to look at the money. I want to say, you know what, Eric, I got a 200-door place. It's going to cost $20 million. This is how much money I'm putting in. This is how much my partner's putting in. This is how much we're looking to raise from these doctors and lawyers and people that want to dip their feet into it. And this is how much the bank's going to give us. Just paint a little picture.
So, for example, we have a deal we're working on. It's 131 units. It's ground up, 2 floors of parking, 1 underground, 1 above podium, 1 above surface parking, and 5 floors wood framed above. So it's called 5/1. But it's really 2 floors underneath, but it's only 1 above the ground, right? So that deal is roughly about 42 million or so. So the acquisition is 2 million. It's an opportunity zone, so it allows us to get what's called 79E, Section 8 in a state statute that basically says you can get 5 to 9 years, depending on the terms and what you're offering to the community as a developer, of no property tax. So what does that mean? On that property, if there are 135 units or so, our tax yearly would be about, I want to say 550,000, just to be safe, maybe 600, but let's just say call it 500,000, right? It'd be 500,000. So even if the minimum we get awarded or negotiated with the town, because you have to go in front of the board and the town wards, basically town districts vote on that, whatever district you're in. So typically they agreed to at least 5. So I pencil 5. So 5 multiplied by 5 is 2.5 million. What did I say the acquisition was? 2 million. You're basically getting the land for free and the pre-construction cost, which is design, permitting fees, all that stuff. So it really is a really great tool, because who would give you free land anywhere? Who would do your pre-construction for free? That's the way I see it. I'm getting free stuff.
Well, Nazar. Listen, I've had a few beers, okay? I had a few beers just now. So I want you to really dumb this down for me. I got $1 million right now. I want you to right now, in under 60 seconds, tell me a deal that you have, where the capital is, how much capital you need, and what I get.
So same deal, 135 units, about $42 million. We're going to get land for free, which is $2 million, and that leaves us $40 million. Out of that, we're going to get senior loan for at least 70%, and we're going to need capital on the rest, which is 30% of the 40 million. So let's call it 30% of 40 million is 12 million, right? No, 40. No, hold on. So,
yeah, you got it right. It's 12
right?
and a half million. 12 and a half million.
12 and a half million.
You need to raise 12 and a half million. The bank's going to cover the rest.
Correct.
All right. So where are you going to get that $12.5 million?
So we have to go to either a single check writer, like a family office, which sometimes it's easier, or we have to raise it from, like you said, 12 doctors, maybe $1 million each. And then we put in at least 10%.
Okay. So the bank owns 70% of the deal. The investors own,
On average.
The investors own 30% of the deal. What are these investors? Let's say I'm a family office. I'm going to give you the full $12.5 million. What am I going to get, and when am I going to get it out of that $12.5 million I give you?
Well, the pre-construction and construction may take up to 3 years, and then the stabilization and hold would be another 5 to 6. So you have to be committed an overall 8 years, maybe 7 at least. And on that 7 years, you would, at the very least, 2.5 your money. So if you brought in, what do we say, $12 million on the exit, your multiplier is 2 to 2.5.
That's 7 years. Okay. So remind me again. You mentioned you have 3 different arms to your company. What is your as you go forward? What is the main arm? What are you going to become known as? What is Nazar or Avatar or Bridgewater? This conglomerate, what is the niche? What will you be known for in the future?
Very good question. So Bridgewater is building a prototype right now. We're almost finished. They call it prototype. We're testing the product. We're making sure that it works. We're about $3 million, let's just say, not over budget. We found $3 million on a $25 million build that we could say if we had to do it again. And that will become a prototype to a trademarked brand, Grand, G-R-A-D, G-R-A-N, Grand. So Grand would be the flag of multifamily line. And then essentially once that becomes established and has pretty good momentum, Grand will also go into the hotel industry and create its own flag.
Okay, so are you telling me, maybe I didn't hear it right, on a $25 million build, you learned how to shave building costs by $3 million. Is that what you said?
Yes.
Okay. So if you can shave this building cost by $3 million, did you say there's something proprietary involved in
There's
that?
nothing proprietary, but if you build, I call it a prototype because it resonates with people. But if you build something that is low maintenance because it's built of good product, it has very good warranty on the roof and the siding and the ephes and the windows, and it has very nice environment to live in, clean, slick, trendy, good amenities, parking, all that good stuff. Like we're building the prototype, so when we're building that in any downtown, we are going to be a staple of that area. What I mean by that, the presence of the design, the lighting, the seasonal ability to light up the building, meaning, let's say it's Christmas, well, it's going to be red and whatever other color. Let's say it's St. Patty's Day, it's going to be green. And I think it's a big deal because that's marketing. It's someone that said, ooh, look at that building. Lights up in different colors.
All right.
So it's small stuff, but I think that all these little details, like developers just build and stuff the people into these buildings, and they don't really like. I've lived in apartment buildings and I didn't feel like I was cared for. I was just a number, and that's what I want to change.
All right. Remember, Nazar, everybody thinks it's just the word real estate. But when I turn on CNBC and I see this guy talking head about real estate, this guy saying we're in a bubble, this guy saying this, I want to know your take. Tell me real estate, and let me know if we're talking about commercial or residential or multifamily. I want you to let me know, where is the real estate market right now currently? Whether you want to talk about Boston or the East Coast or the United States as a whole, I want to know where the real estate market is currently. And I also want to know where you think it's going over the next 3 to 6 or 7 or 8 years.
Great question. I believe that after 2019, the history was wiped out. There's nothing to look back to look at numbers other than up and down markets and bear markets and depressions and recessions and et cetera. But what has happened during COVID is something that A, nobody predicted, and B, really has no factual history to look back to. So now that that COVID is over, now we have to start over again. You see what I mean? So we're not back to 2019 because COVID created a ruckus, but what's interesting is what I've been watching the Fed do is how recklessly they approach this. And I understand that nobody knows how to deal with such craziness that happened in 2020, 2021, and so on. But they overdid it. And what I mean by that is lowering the interest rates to a ridiculous amount like that causes consequences. It's kind of like if you have a business and you just start giving everybody double the pay of what they're making without really understanding what your working capital is and what that's going to domino effect. There was no reason to do that. But you know what? Hey, they panicked and they did this and blah, blah, blah. Who knows? But then when you see they crank it back up within 6 months to doubling what they lowered it down to, it's completely irresponsible of them. And then they take $2,000 or $1,200 or whatever they did, and they gave it to each family, each person in the United States. Did that move a needle? Or should have they taken all that money and put into grants for entrepreneurs to be eligible to get business, any kind of business started that's needed in the country or community? What about SBA? They're so uptight. Trying to get a loan from them is like almost impossible. Why? Why couldn't they put that money into grants and SBA? That would move a needle. So that putting that aside, cranking the interest rate so high because they were so concerned about inflation. Well, you created the inflation. Now you're making it even worse. So who's paying for this? Poor citizens, poor people paying for this. A lot of businesses went out because if the interest rates go up, you can't almost do anything. Multifamily wouldn't pencil. You can't get a mortgage because it's too. You can't buy a house. I'm sorry. So what happens? Trade stops. There's no money exchange. People sit on the sidelines with cash that's depreciating because of inflation, and everything just stops. They purposely did that. You know why? Because they overdid it with irresponsibility. But then instead of easing the interest, I'm not against the high interest rates. Whatever they got to do to get the money back, because they lost the money when they turned the interest rates down. So you have to get the money back. But you don't go just turn off the faucet and then you just crank it all the way up. It's obnoxious. And you're disrupting businesses terribly. The balance sheet is like this. And you can't even look back and say, okay, 6 months ago I lost $2 million and now I'm doing better. How can you be bankable? Businesses can't get a line of credit like this. You basically screwed the people by doing this. Okay, past tense, the interest rates are going down. They're stabilizing a little better. Thank goodness. Things will be better. But I do believe that with what Trump is doing and how Federal Reserve has seen their recklessness, I think, I believe that driving the interest rate lower to a stabilized level will move all businesses to the ability of borrowing money from the banks, investing into deals because they're investable, right? All has to balance, DSCR, yield on cost, IRR, and all these components and gauges that make the industry move. What moves the economy? Construction. It's not the tech. It's not the biotech and all this stuff. What happened to biotech after COVID was gone. Poof. Investors lost money. They all thought that, oh, because of COVID, are we going to do all these labs and stuff? And I'm just thinking to myself, it's a flu. What are you doing? It's not cancer. It's going to go away. And investors poured big bucks into these biotechs. They lost big bucks. Absurd. Bubble. Foo-foo. Multifamily on the other side was multifamily and still is, right? So when the interest rates go up, people can't afford houses. They do what? They rent. If the interest rates go down, most likely they will go buy a house. So there's a trade constantly in multifamily. In what? What are you going to do if you can't afford rent or have an apartment? What happens next? You're a bum. So that's your last stop. It's not like a car where you're like, well, I'll take a bus. If you don't have an apartment, a roof over your head, you don't have a bus. The bus is a bomb shelter, homeless shelter. So I feel like the apartment investing, yes, there's ups and downs, and somebody doesn't pay this and that. You have higher vacancy, and you have to have some concessions, but it's a great vehicle for tax deferment and tax liability, but also passive income and a hard asset that just doesn't like crypto, all these knockoffs or whatever, all of a sudden just disappear. Or stocks. Like say you invest into a stock and the company goes bankrupt. Are you going to go and take their computers out of their offices to go sell it at an auction? Mm-hmm. You can't. But if you're an investor in a hard asset and it goes poof, you're going to stand in line and get something. So I think what Trump's doing is the right thing to do. And as much as tariffs suck on the cost, for construction, but I, as a developer, as a capital raiser, as a fund manager, I'll take increased construction cost over increased interest rates. Why? Well, because I can't control interest rates. I can't go to a bank and say, you know what? I know you charge 7 or 10%, but how about 2? I can't negotiate them, but I can strategically negotiate and maybe go to different countries to buy materials or invite them to come and build because I can. I have that ability. So interest rate is super, super important to be in an affordable percentage that underwrites deals and mortgages, which moves things along. Banks want to give the money, but they can't give it to people that don't qualify. And how many qualify with such craziness? And then the last thing I want to say about the tariffs is I think people hate them, but I say that I think the American people, especially that have been rooted here from centuries, their grandpas, their great-grandpas came, maybe they were at war, concentration camps, whatever, and they paid their price. And to see generational Americans struggle, not having enough bread on the table, is bizarre. It's not right. And I think Trump trying to change it. And what I mean by that is it's time to leverage the big boy USA against others. U.S. has helped all these countries throughout the years. Oh, there's a crisis here. U.S. steps in. At whose cost? Because America has the money? Because of taxes to people? No, how about this? Get rid of the taxes. Property taxes, income taxes to a certain level, let's say $150,000, $175,000. Those people shouldn't pay income tax. It's just, they don't have enough money to live. You need to make a serious amount of money to afford to live today, normally, like a human being with 2 kids that can go to some school. And use that leveraged tariff percentage and fund colleges, scholarships, grants, SBA, hospitals, rehabs, drug rehabs, detox, shelters. That's where we're lacking this. Sending a family $1,200, what is that going to do? They're going to just put a smile. It's going to put a smile on them for one day. They're going to go blow it somewhere, and it's going to be over. That's not trade. But how much money is that? How many shelters could that open? And it should be done equally to other countries. So Mexico should pay the same. Australia should pay the same. And there would be no fight. China shouldn't pay 50 and this guy's 10. It's just, it creates nonsense. I think that's where he's kind of screwing up a little bit. I think it should be leveled out, and it should be permanent. Why? Let's just imagine the tariffs are 10 to 15% on all products coming in to United States, which is the largest consumer in the world. Do you think they're going to stop bringing the product in because of tariffs? They still have to send to the largest consumer in the world, but in such a way that the prices don't really go up much, and they will figure out how to make it happen. They meaning other countries, manufacturers. 15% is not a lot. But all this talk about milk went up and eggs went up, and who cares? Use and leverage U.S. with the massive military and all this financial opportunity. This country is beautiful. I agree with Trump. I mean, what are we doing here? So I just hope that that's what he does. And lastly, I really think that with him as a president, and financially speaking, I'm not saying I approve his other things. I'm simply talking finance, business, not personal, not my opinion. It's just who I think he is as a businessman and how good he is as a businessman to this country. He knows what he's doing. With him being in the office for, 2 more years, I think, right? 3. And post effect of economy. Like, the economy doesn't change in 6 months. It rides for at least a year or 2. So if he's in the office for 2, I'm betting on 6 years. So I do invite all investors, anybody that's listening to this, to act now, buy now, and you'll exit a lot better in 3, 4, 5, 6 years, because the interest rates will keep climbing down, which will improve real estate values. And that is over the time of, say, 6 years, the appreciation will be in bananas.